Well, thank you everybody for joining us today on the exciting topic of cannabis in Virginia, which has definitely gotten off to a rocky start, as we know. I would like to see actually perhaps in the audience, folks who are actually working in the industry and people who are not. It's always kind of interesting to me because I know as new states come online, we get to see who actually gets to work in the industry and who's kind of new and wants to know some of the more foundational issues, especially related to tax. Because for some of us, I think that have been in the industry for a while, and I've been in the industry for a little over 10 years, and I'm specifically focused in the industry out of California. Some of these topics I'm going to go over today are very foundational and kind of older concepts. They've been around for a while, but for some folks, they're going to be a little new. So I'm starting at ground zero when it comes to a lot of the tax concepts within cannabis. So that's where I'm going to start. And feel free to put any kind of comments in the chat. I'm happy to answer any comments or questions that you have. Okay, with that, I am Rachel Wright of 420 CPA. The firm has been in the industry since 2009. And I have been in the industry for about 10 years. We service clients, cannabis clients across the whole country and some that actually go internationally. And so it's quite interesting just to see how the landscape has changed over the years. But it seems to be the same issues in every new and emerging jurisdiction, whether it be a municipality, city, or even in a state. Funny enough, even new countries that are coming online have a lot of the same issues as well. Seems to be history repeating itself over and over and over again. So with that, we'll proceed. This is just a general overview of the part one of what we're going to talk about. So tax planning for cannabis related businesses. And so when I talk about tax planning for cannabis related businesses, I am specifically talking about those businesses that actually touch cannabis, not necessarily the ancillary, what we call ancillary businesses. So ancillary businesses could be, real estate. It could be a brand that does not actually produce its own product. It could also be a security company or a marketing agency or attorneys or a CPA firm. So those are not the cannabis related businesses that we're going to be talking about. Today, we're going to be talking about specifically cannabis touching entities, cultivators, manufacturers, processors, retailers, and everything in between. So we'll do a little bit of background. We'll talk about the obstacles in reclassification. We'll talk about basics of record keeping, the difficulties in cash and cannabis, just a general overview of entities and structuring. And with that, I'll proceed to the next slide. And then part two we'll do a bit of an overview of the state of cannabis in Virginia, the legalization or lack thereof, as well as we'll go over the state and local tax in Virginia on cannabis. Okay, so I'm going to use the term cannabis. This is just a little jargon slide here. However, technically, cannabis encompasses hemp and marijuana, hemp being no more than 0.3% Delta-9 THC, and then marijuana technically being more than 0.3%. So if we're getting specific about terminology here, what I'll actually be talking about is marijuana, but I will refer to as cannabis. So we can see the legalization landscape here, and specifically Virginia that we're talking about, medical and arguably recreational. we'll definitely get into that in a later slide, but for the terms recreational is another term that's used interchangeably with adult use, where you don't have to have a prescription, a doctor recommendation, or any kind of state issued ID card. You just have to be of the right age to be able to purchase. Okay, and so we're going to talk about the potential rescheduling of cannabis. Right now, cannabis is on Schedule 1 of the Controlled Substances Act. Because it has the high potential for abuse, there's no currently accepted medical use and treatment, there's lack of accepted safety, and so this is what creates a huge issue in cannabis taxation. And we'll talk about what that means with 280E and why 280E is so difficult with regards to how cannabis operators and businesses are trying to survive, essentially, at this point. So 280E, we will talk about that in a minute, but very, very high level before we get to rescheduling is essentially, and this is oversimplified, we'll get into it a little bit more later, any cannabis touching entity can only deduct what's called cost of goods sold. And the trick is, what is cost of goods sold? Okay, so I hear a lot of misconceptions about what cost of goods sold is, and we're not going to dive too deep into it, but generally it's very different for retailers versus somebody who is actually manufacturing or processing. So anybody who's not producing or manufacturing the product is actually a lot more limited in what they can deduct. And there's variations on that point. There's really no black and white. But if we just take this kind of at face value, under the Controlled Substances Act, as a Class 1 drug, cannabis businesses can only deduct what's called cost of goods sold. So the DEA has suggested rescheduling to Schedule 2 or Schedule 3. Actually, it says Schedule 2 here, but it's actually Schedule 2 or Schedule 3. And what that means is, generally for cannabis businesses, that they won't be subject to this onerous federal income tax, and they won't be subject to 280E. And so that's what most of the businesses are really hoping for. And why would it move from Schedule 1 to Schedule 2 or Schedule 3, hopefully Schedule 3, is because they've actually moved the classification for a lower potential for abuse as opposed to a high. They've actually adopted that there is an accepted medical use, and they've generally accepted the safety. So the DEA recommended cannabis be reclassified in April 2024. That wasn't so long ago, and I know everybody was really, really excited when they heard this. And immediately the industry said, oh, well, now we're not subject to 280E, but I said, you know what, not so fast. And it's going to take some time. And so, you know, we have a lot of different hoops to jump, and we have, depending on what happens in the upcoming election, and depends on which parties actually get into office here, it may continue to move forward. It may not continue to move forward. We're not really sure. So I would say don't really hold your breath and plan on the reclassification of cannabis to Schedule 3. Okay. So here's a little bit more on the rescheduling aspect of it, and the benefits. So the better tax treatment, removal of 280E, So instead of having only cost of goods sold, people would be able to deduct expenses just like all other businesses are able to. Yeah, I guess we could say that there'd be a reduction in the stigma. I think that's already happening anyways. So the stigma of who buys cannabis, who consumes, it's definitely getting more broad, and the perception of who uses it is changing all the time. So rescheduling doesn't mean that all of a sudden banks are going to get into the banking industry. Okay. It doesn't mean that there's still going to be some obstacles. There's obstacles between, how will the states adopt this, who don't want cannabis to be legalized potentially. What is the interaction and what is the interplay between the medicinal licensees and then the recreational licensees? So there's just so many kind of unknowns, including the timeline. It could be years, right? So I've highlighted down here that cannabis businesses and their advisors must continue to operate as before. So it's like business as usual. On another hand, we do really expect in the next few years, especially with rescheduling, that potentially investment is going to be more free-flowing. I think that's going to be very helpful. We've already seen, even with the idea of rescheduling, that investors are closer to getting ready to investing in the market more readily than they were before. There will always be investors, but we need more of them for sure. Okay, current challenges presented by the Controlled Substances Act, taxes and banking, as we know. So here is that Internal Revenue Code section 280E. No deduction or credit shall be allowed for any amount paid or incurred during the taxable year. So think about that. No deduction or credit is allowed if a business consists of trafficking a controlled substance within the meaning of Schedule 1 and 2 of the Controlled Substances Act, which is why I said the rescheduling is actually a suggested rescheduling to 3, because actually here 2 would not be good enough. If it gets rescheduled to 2, they're still subject to 280E. So I think that's really important to note the difference. So there are a lot of case studies here, which we're not necessarily going to go through all of the case studies, but all these are case law. But a lot of these case laws have helped us to structure how we work with cannabis clients, their entity organizational charts, how they can actually get least impacted by 280E. And so there's not really many, if any, wins on this list of cases right here, but we certainly learned a lot. So if we look on the left-hand side, you've got a legal business. You've got sales of $100,000 or $100 minus $50 cost of goods sold, and there's your gross profit. And a normal business can deduct $30 of their overhead, and then you have your taxable base of, say, $20. And right after that, you'll see the income taxes, right? Well, in a federally illegal business or one that's under Class 1 and 2 of the Controlled Substances Act, this is what we see on the right-hand side. You see that they're actually taxed on their gross profit as opposed to on their net income or taxable income. So here you'd have sales minus COGS. There's your gross profit. Now, a lot of people think that cost of goods sold is actually a deduction. It's not a deduction. It's an amount that allows you to arrive at your gross profit. It's a reduction of inventory. It's a relief of your inventory costs. So if we think about inventory costs for a cultivator, for example, it's going to take labor, it's going to take soil, it's going to take machinery, fertilizers, all of the different components that go into growing a plant. Additionally, you can potentially add overhead because you're actually producing a product. So that would go into your inventory, that would get capitalized into your inventory and relieved through cost of goods sold. So cost of goods sold is actually not a deduction. So I just want to do a little bit of tax terminology there. Everything that happens after the gross profit line is actually what we call deductions. So anything below the gross profit line is what a cannabis business would not get to take advantage of. The trick and key in cannabis tax planning is what can you reasonably allocate to inventory, direct, indirect overhead costs, and then what can you then deduct or reduce to gross profit. Okay, here's another revenue code section, 471C. And so essentially 471C came out with the Tax Cuts and Jobs Act in 2018. And this is something that the industry has really, really embraced because as the industry has really matured, each business owner has had a really hard time of keeping up with all the regulations, all the onerous regulations, onerous tax laws, not just at the federal level, also at the state and local level. In some areas, there's tax on tax on tax. And so business owners have had a very difficult time. Additionally, if we think about folks do actually have difficulty in banking, and we'll get to that in a minute. And there's still a lot of business owners that operate in cash only, because they don't want to necessarily pay for deposit pickup fees and things like that. So if you think about where the industry is at right now in maturity, there's still a huge thriving illicit market, I'll call it. And that makes competition very difficult. And so these business owners are competing with not only a rather large illicit market in most states, but they're also dealing with overregulation and overtaxation. So for those folks, I don't want to say that 471C is just for the people that are absolutely struggling. It can be potentially almost like a safe harbor, and I use that term very loosely, but what 471C means is that in this case, if you have a smaller taxpayer who's under the threshold for the gross receipts test of 448C, which I think, actually, I don't know that number off the top of my head right now, but it's somewhere around 26 million, and it goes up every year for inflation. So let's say we have a business, let's accept that 26 million is the threshold, and you have a business that is under that in gross revenue. You may want to opt in for 471C because then it's kind of considered a small business, and reasonably, if the taxpayer's books and records show a certain amount in that they've allocated to cost of goods sold, you can actually opt to use that method to prepare your tax return as well. Okay? So imagine you have a taxpayer, a business owner, your client, who has a set of books based on how we just showed a normal business versus a cannabis business, strict reading of the law. And let's say we have kind of a hybrid method in between that. Now, it's risky. I've personally been through audit on one or two of these, and as long as you're reasonable, I think, and you go into an audit reasonably, and obviously it depends on the auditor, I've actually seen this position pass. I think you can go very, very aggressive with this tax position, and I think that's probably not wise. There's what's referred to as like the all-in approach. You can go all in and just say, okay, well, I'm just going to throw everything up in a cost of goods sold then if I'm going to use 471C, but that's probably not wise. And so that's one way that you can actually go with this, but I don't recommend that. I recommend like a middle of the road approach. And it's on a taxpayer by taxpayer or client by client basis. Essentially, it really just kind of comes down to their risk appetite and understanding, the risks and rewards. And so that's what you talk about that's what I talk about with my clients and other folks that I meet. But what I've heard a lot recently is, especially in the newer states that come online, and I imagine Virginia would also be one of them, is I hear a lot of fallacies, and people are just generally very scared. And they'll say, hey, there's nothing but inventory that's deductible in a cannabis business. And that's a blanket statement. So you can hear, based on everything that I just said, that blanket statement is actually not true. So I would say be quite careful when making blanket statements such as that, because it's really hard. It does harm the business owners because they are getting that kind of information. And so they're deducting a lot less than they're entitled to. And so years down the road, especially as market matures in each state, they're just going to have that much harder of a time. So essentially, I think, the job of the attorney, the job of the CPA and the industry is to present all options and not the broad brushstrokes, because if anything in this industry, there's no broad brushstrokes on anything. Okay. So this is another summary of the Internal Revenue Code Section 471C. As I said, the Tax Cuts and Jobs Act, and a couple of other code sections, which 471A talks about capitalizing into inventory is allowed for producers, and et cetera, et cetera. So I'm going to move on because I think we talked enough about that. So what are inventoriable costs? So if we remember that cost of goods sold is not a deduction, it's actually what you can put up into inventory, what you can allocate and capitalize into inventory, and then relieve through cost of goods sold to get to gross profit. It's really, really, really important to look at what can we put into inventory, because it becomes a reduction of your taxable income. So inventoriable costs for producers, this is just an example, not an exhaustive list. But the way that we separate this out is between producers and non-producers. So you have producers, which include cultivation, extraction, production, labor, rent, and a lot of actually other overhead costs. And kind of very strict reading non-producers such as retailers and some distributors. Retail would not be allowed to deduct labor, rent, advertising, and many other costs, only the costs to purchase the product. But again, like I said, there's no broad brushstrokes here. That's just if you're reading very, very strict reading of the law. Okay, and so as you can imagine, with such a heavy tax burden, it's really, really key to have the right systems in place. And you'd be surprised how many people I see that are on Google Sheets, especially some folks that are actually still using cash. They're using Google Sheets to track their sales. Yes, there may be a track and trace system or a seed to sale system with, in that state. But outside of that track and trace system, which sometimes doesn't actually record dollars, depending on who if you're a distributor or something like that, sometimes it doesn't record dollars behind the transaction. It can track weight. So you can imagine that folks sometimes don't even have an actual system that's going to be tracking their finances. So if we look at systems here at the bottom, you've got a POS system. The POS system is the retail side of the system. So if you're at a dispensary or a retail store, you'll see a POS tracking, or you have ERP. So ERP is, enterprise resource planning. It's more for wholesale, cultivation, manufacturing, more complex operations than kind of like a B2C POS. So record keeping and audit defense. I know it sounds like I'm stating the obvious here, but I was just, one of my clients was in an audit not too long ago. And I actually took over the audit for another CPA, and I was brought in. And essentially the books and the record keeping were not good. And these are not always just small companies. They're rather large companies too, what I consider large. And I'm always shocked to find these larger companies operating without, a decent set of books, without keeping proper records, and things like that. So in this case, I took over the audit, and it was an older year, and there were no good books. I looked in the QuickBooks file. QuickBooks is just fine for cannabis. I think that's actually most of what our clients use, and we recommend they use. The books were not good. So we literally, luckily, gratefully, and this was their saving grace, is they had boxes and boxes of documents, and they were able to scan them, and these substantiate all their expenses. And we essentially produced all the records, scanned them. I produced a spreadsheet, and we came out with a $0 change. And they were looking at multiple millions of dollars. And then one of the more serious parts of that situation is that the IRS agent was going to move on to the next couple of years if this first year didn't go very, very well. And those subsequent years, 2020, 2021, were very, very high revenue years. And so I really wanted to stop them at the beginning of the audit, and I was able to do that. And gratefully, it's because, obviously there's a lot of strategy, there's a lot of talking to the agent, doing a site tour. So often you have to do a site tour of the facilities. Your narrative has to be correct. But additionally, if we didn't have any records, the agent would have moved on to 2020, 2021, and that taxpayer and my client, would definitely have a big problem, I'm sure. So luckily, because they were able to produce all these documents, we were able to scan it, just stick it on a spreadsheet, give it to the auditor. They stopped at that 1 year, and they never went any further. So this is stating the obvious, but you'd be surprised how often the record keeping is not done very well at all. Okay, and so next, part one, tax planning for cannabis related business. Oh, cannabis is not spelled right. I just saw that. Ignore that. Tax planning for cannabis related businesses. Income taxes, state and federal. Planning point is you want to look at whichever states that you're working in. States may or may not conform to that 280E, 280E being the tax code section that we talked about earlier. So some states actually don't conform to 280E. Virginia actually does conform to 280E. So I think that's pretty interesting to know that some states can, some states might not. So I live in California. California does not conform to 280E. So what this means is you have two different types of tax returns. Essentially, you have a federal tax return subject to 280E with reduced with actually increased taxable income, and then you have another state tax return. So in California, we have another state tax return. We then get to deduct all of those expenses on the state tax return. Now, this webinar is on Virginia. Virginia does not, Virginia does conform to 280E. So you would have the same rules that we're talking about here for the feds. You'd also have the same thing in Virginia. And Virginia seems so far, as I've been looking into it, not to be the most friendly cannabis state. So that actually doesn't surprise me. There's also tax planning at the level of, actually a lot of the tax planning that we do is at the state and local tax level. You would be surprised. So there are areas to look in with regards to sales and local taxes. As you'll see, we'll get a little bit further on. You'll see that not only can a jurisdiction tax cannabis, but then you have, so a jurisdiction like a municipality or a city, they can tax cannabis up to 3% here in Virginia. But then you're also going to have state and local state taxes on top of that. It could be a mix of potency taxes, it could be a mix of excise, sales tax, whatever the state wants to add. So there are very specific planning points that you can look at here at the state and local level, which is, I'll give you an example. So in California, there's a tax on tax on tax. So there's local tax, and then that's your first layer of tax, and then you actually add another layer of tax, which is excise tax. Then you have to actually add another layer of tax, which is sales tax. So tax can be compounded on top of each other. Luckily, so there's another state as a contrast. New York does not compound taxes in that way. Okay. So we really have to look to when there's issues with compounding, you really want to read obviously the ordinances, the tax ordinances, and I think that's really key. And then also look at what is actually included as a taxable base. So you really do want to look into the ordinances and the definitions and things like that, because you can actually save folks a lot of money in that way as well. So transfer pricing issues, I'll touch on that very briefly. So in cannabis, as you can see with 280E, it sounds like people want their cost of goods sold and their inventory to be as high as possible. So if you imagine you have a cultivator and then you have a retail store, and they're both owned by the same people. They know that cultivation, the costs in cultivation are much more deductible than at a retail store, because we've already discussed that. I already talked about that, and we all know that. So people come up with the bright ideas of, oh, well, we'll just increase our price from the cultivation. We're going to sell it at this extremely high price to our own retail store, and people think they've figured out a workaround, but the IRS has already thought about this. They thought about this with transfer pricing and the transfer pricing rules. And it's funny because people generally think about transfer pricing as an international tax issue, and usually it is. People trying to shift profits overseas to lower tax jurisdictions. And that is not the only time that transfer pricing comes into play. It actually comes into play in cannabis as well. It's a place you wouldn't likely think about it, because transfer pricing actually involves non-arm's length transactions. So two related parties or somebody who is one and the same, rather than an arm's length transaction. Arm's length, two parties will sell each other products at market rate, right? So if you think about, I own a cultivation, I own a retail store, my motivation is to get my cost of goods sold as high as possible. I'm going to sell it to my retail store. at the highest cost possible. Unfortunately, that may not be respected by the IRS, because they can come in and they can, at will, if a reasonable method was not used to determine what that sale price is, they could actually come in and impose a price that is a market price. It needs to be an arm's length standard. So banking in the cannabis industry, because of the Controlled Substances Act, and also the Banking Secrecy Act, it's just made life very, very difficult. I have a couple of slides on this, but I don't want to spend too much time on the potential Safe Banking Act, which has gone around and around and around, and seems like it's never going to get anywhere. So I don't want to waste too much time on that, but we do hope that eventually some type of Safe Banking Act will happen. Right now, well, let me actually bypass this slide a little bit. So here's kind of the progress or lack of progress that's been made in the banking legislation, but ultimately it's stalled out and gone nowhere. So just in general, cannabis businesses, I still run across some, and I'm always shocked when I see the ones that are operating solely in cash, because I do say, years ago there really was no other alternative but just dealing straight in cash. Now there's a lot of alternatives. There's a lot of credit unions, and there's even, I think there's actually a couple national banks. There are a couple national banks that will work with cannabis clients. You need to be transparently banking cannabis. So in other words, you need to disclose. Don't try to hide it. Don't form other companies and try to filter money through that. That's called money laundering. So these are not good ideas. You should be, business owners should be disclosing to the bank, going to opening a cannabis transparent bank account, and working with those types of banks. So this is not as big of a problem as it used to be. However, these banks will give you a debit card sometimes. That's very helpful. However, it's very difficult to get credit cards. Okay. So if you have a cannabis company, no credit card, nobody's going to give you a credit card. No, if you disclose that this is cannabis. Merchant services is also quite difficult, but doable with debit cards. So there's still just, the industry is being crippled quite a bit because of this issue. Okay, so I want to see if anybody has any questions. As of yet, I don't see any questions, because that was definitely the federal section, and now we're going to move into the state section. We have about 20 minutes left, so please feel free to ask any questions that you feel like you want to ask. So we're going to move into Virginia, which obviously I don't live in Virginia, but I was able to kind of research and see what's going on and talk to some folks who actually work there and are working, lobbying for various causes in Virginia for more recreational or adult use sales, because it's been quite an interesting path. So in 1996, as you can see here, here's the evolution of state legalization. It's funny, it kind of moved from the West out to the East, and I'm originally from the Northeast, so I understand that. But out here in the West, things were happening, a decade before it started out in the East Coast. And so you could see 2012 with Colorado and Washington, that was a long time ago. That's for recreational purposes. That's adult use, non-medical. In 2015, Virginia fully legalized for medicinal purposes. So that's why you see some dispensaries around. 2020, Virginia decriminalized for simple cannabis possession. And this one was interesting. This kind of caught me off guard here when I was researching the history of Virginia cannabis law legalization. So Virginia technically was going to legalize for recreational, and then adult use was supposed to begin in 2024, but needed reapproval. And unfortunately, the administration or the governor that came in declined to pass any kind of adult use laws. So I'm not sure what's going to happen with that, but at least you have medical in Virginia. So there are not that many medical licenses in Virginia. So you have 4 licensed pharmaceutical processors for cultivation and packaging. That is not that much to supply a whole state. And then you have 1 processor in each of the 5 health service areas. So you can see the 5 health service areas down there. They allow 1 for each section. And again, that's really not a lot. It puts the power for processing in the hands of very, very few. And we've seen a lot of issues happening with things like that. When you don't allow for competition and businesses to flourish, and you really limit the kind of who's allowed to process. And this is, I guess, governed by the Virginia Department of Health. They oversee this. And so they would tightly watch this and probably monitor the processors, I would hope, to make sure they're producing good product, because there's a lot of issues with like testing facilities right now, corruption in testing facilities, and saying it's more like a pay to play. And so obviously you don't want that, but you do kind of want a healthy mix of somewhere in between. As far as dispensaries, retail stores in Virginia, you can have a max of 6 dispensaries in each of the 5 health service areas. I didn't do a study on, how big these are or the number of people that live in each jurisdiction, but I can imagine 6 dispensaries is not a lot. In California out here, we have 1 on every corner. I think that maybe that's a little too much, but 6 dispensaries to service that huge population, I think it's going to be good for those particular businesses. So at least you don't have overcrowding, and the competition is reasonable, and each dispensary has the ability to actually make a decent and healthy profit. So I think that is really important. But this definitely seems very, very, very conservative, especially if we're coming from the standpoint of servicing the population, and if we do see this as a service. So each dispensary, this is really, really interesting. Each dispensary must be at least partly owned by the pharmaceutical processor in that health service area. I'm not even going to comment on that. I think that's extremely interesting as well. Okay. Medical consumption, a broken system. So you could see kind of exactly what we're talking about right now. Virginia's already off to a very, very interesting start. Very restrictive start. So there's a number of residents. So there's estimated only 0.5% of the total population is actually medicinal or medical patients. 90% of patients reported purchasing from other than illegal dispensaries. So this is generally what we see, is when it becomes so restrictive of either a state or the feds restrict quite a bit. You have a flourishing illicit market, which makes it, even harder for those businesses that are working to become licensed legally and service patients or customers legally. it makes it hard for them to actually be able to do that in a profitable way, which I think is very, very important. So there are actually people growing at home. That is allowed. I didn't look up the limits on that, but 50% of patients grow at home. And here, as you can see, Virginia versus Florida versus Pennsylvania, and Arkansas, the price for an eighth, 3.5 grams. So you can see in Virginia, it's very, very, very high right now. And you usually do see that at the beginning of the opening of a market. It usually does start out quite high until it becomes a little bit more mature, but there's kind of a good comparison. So this, despite the ease of access to the medical card, any conditions as determined by a doctor. So it says no excise tax here. That's for medicinal. So remember earlier on, I was talking about 280E conformity. States can either decide to conform or to not conform to 280E. It's really up to the state to decide. And they just rewrite their own, revenue tax code within the state. So here in Virginia, unfortunately, they conform to 280E. So you're still going to have that same restrictive tax code. You're going to have one tax return. A certain amount of stuff is deductible, and a certain amount of expenses are not going to be deductible unless you decide to take a little bit more of an aggressive tax position. Okay, so state and local taxes. It's always important when operators now, I don't think that that's going to happen as much in Virginia because it's so restrictive on the number of licenses that are allowed in each health service area. But usually you would have kind of overpopulation of businesses in certain areas and over concentration of businesses. But because it's so restrictive on the number of licenses issued, I don't think we're going to have as much of this problem. But in other states, it's actually very important to decide which local jurisdiction you want to work in, because some local jurisdictions, some don't even have cannabis taxes or cannabis tax ordinances. And so I don't think you're going to see that happen in Virginia, but just keep in mind that local tax on adult use is not to exceed 3%. So what that means is that each local jurisdiction has the ability to charge varying rates. So if they actually want to, they could charge lower rates to try to attract businesses to their jurisdiction. And I've seen that before. So the local tax is not to exceed 3%. So I think that's one layer of tax right there. And right now with the current medicinal and medical sales, the only other tax that is going to be on the cannabis outside of the local tax is going to be the 5.3% sales tax. So right now there's 2 layers of tax. So once adult use is enacted, then there's going to be a state excise tax. And so when we look at these things, we really need to understand how the tax works. Is it going to be, as I mentioned earlier, a tax on tax on tax? It's very, very important to read the tax codes, ordinances, and see if there's going to be any stacking here on the taxes. I didn't read the code, so I'm not quite sure yet for the excise tax, and we don't really have adult use yet, but it will be important to be able to check that out. So, but kind of exciting news. Recently, there were differing bills that were passed by the House of Delegates and the Senate in Virginia to be negotiated, and expected adult use sales will begin in 2025. So I always say, like, any kind of news that we hear that is not confirmed, I'm always a little very half skeptical about it, such as like the DEA rescheduling that we were talking about earlier. I just always say, just don't hold your breath, but it seems like all the states are eventually getting on, they've got to eventually get on board. I guess they don't have to, but it would be odd to have one state surrounded by a sea of states that are either newly legalized for recreational purposes or soon will be. So I imagine they're going to get on board because in general, you can see how much tax revenue it brings in. 21% excise tax. It's kind of a no-brainer in my mind from a tax standpoint. So both bills actually had a lower excise tax. So for reference, the excise tax here in California is 15%. So 21% is rather high. That's very, very high. So it's kind of interesting, though, those bills were vetoed because he said that recreational and adult use endangers Virginia's health and safety. So stay tuned, stay tuned. Okay, so here's some projections on potential revenue from adult use sales. That's a lot of taxes. So to the point of why wouldn't we want adult use sales? Now, I understand, I guess, from other standpoints, I look at this purely from kind of a tax and revenue generating standpoint. So either folks can buy on the illicit market, which is already happening. We already said that 90% of patients purchase on the illicit market, or we can do this in a regulated way and bring in tax money for the state. And to me, it's a little bit of a no-brainer. You might as well capture those sales. They're happening anyways. Okay, so I guess that was my last slide. Let me go over just kind of, the industry in general right now, the landscape. I think that's going to be very, very helpful to put everything in context and put everything together. I'll go back actually to that state slide. So we can see the state evolution from 1996 to 2021. And now it's 2024. So you can imagine a lot of states were actually legalized. You can look at Colorado and Washington. Those states were legalized a long time ago for recreational purposes, 2012, over a decade ago. Now in 2024, the Northeast is coming online, the Midwest is coming online, the Southeast is coming online with a lot of medicinal, medical uses. So the country's kind of turning. Everything's turning around state by state by state. We saw that map of states. And I think that for cannabis as an industry, that's very, very hopeful. Now, remember, that's going to bring a lot of challenges at the same time. So what we're seeing is obviously a much more mature market. We're seeing that in some of the more mature states that prices have dropped. So in our earlier slide, we said, I think the eighth was like $50 per eighth in Virginia, which is really good for a business owner, not so great for the consumer, but definitely great for the business owner. And so what you'll see obviously as a more mature market takes place, those prices are going to drop down. And depending on like supply chains, there tends to be an oversupply. And so those prices for the suppliers and producers could potentially go down as well. And so because there's more supply and demand. And so I think also what's happening is because of overregulation, overtaxation, the illicit market has still continued to thrive. So today, the legal business owner, the folks that, and it's not easy to start a cannabis business. They have, it usually takes a large investment. And especially if you own your own real estate, and you're going to invest in real estate, then even more of an investment. So folks that have stores, have any kind of operating facilities, have spend a lot of money to get these facilities going, even just through the licensing process, and even potentially if you just rent a building. The hurdles that most folks have to jump to even be able to rent a store or a facility in general is very costly. So, so I think to me, the goal is to curb the illicit market as much by making it easier on business owners, making it easier on consumers, potentially lowering some of the taxes. And I think eventually, perhaps the illicit market will go, their sales, their market share hopefully would go down and give the business owners a little bit more of a stake in operating and a little bit more profitability. But the reality is that we are actually moving to a more mature market. And when a market does mature, then kind of the next stage that we need to focus on is actually efficiencies. Operating efficiencies are the most important. And so in other words, you really need to look at all your costs, what you're selling, the types of products you're selling, do the customers actually want it, things like that. And that's part of the difficulty, I think, is that many of these states are in a more mature phase, but they're not necessarily business owners. So I think that is really important as advisors, that we come in and help them to become more mature and act like a business. So with that, I'd like to again kind of go back to the last slide and say thank you so much for attending, and please feel free to contact us. Actually, that telephone number does work, but I would prefer you email me at the info@420cpa.com. With that, thank you so much for attending.